association. Yeah, see, that's the association. Joe.
All right, guys. Welcome to the YMA Nation podcast, episode number 12. And this is
Rebecca Wallace.
And we are doing today
Real Estate Wednesday.
All right. So we got Joe Wallace and Rebecca Wallace today, YMA Nation podcast, Real Estate Wednesday. Thank you guys for joining us today. I'm excited. It's your show today, right? This is the expert in that industry. So before we get started, guys, make sure you like, comment, and subscribe. Give them 5 seconds to subscribe.
Now, he know that's going to be longer than 5 seconds.
This is how we going to start the show off, guys. Y'all hear that energy?
Than 5 seconds.
All right, guys. So make sure you have subscribed. Now, we're going to get started on the first thing is the drawing, right?
The drawing, yeah.
How do you guys like the new background? Yeah.
Woo. Hey, hold on.
We get some claps. All right, guys. Good. All right. So, if you guys are not familiar with the contest or the drawing,
right,
during the show, there's going to be a keyword that she is going to announce. You don't know when, so you have to watch the whole show because you have to watch the whole show.
You got to watch it.
Down in the description, there's going to be a link. And you click that link, it'll take you to the website, and you just put in the keyword and your information, and boom, you'll be entered in the drawing.
Free money, $25.
Free money.
Yeah.
So we're going to choose 4 people, and those 4 people are going to win $25 each. Are you ready?
I am ready.
You going to pick them and hand them, and then I read them? I get to read them on your show? All right. Let's get going.
You ready? Okay.
Winner number 1.
Who is it?
Antonia Young.
All right.
Won on Wealth Building Monday, too.
Really?
Yes. Thank you for supporting and participating and following our podcast, Antonia Young.
Great job.
All right, number 2.
Number two. Who we got?
Travis McKenzie. Wow.
Look, this is proof that if you just look and watch and follow, you can win.
You can win
multiple times.
You can win.
You ready?
Next one is Tina Riley. Congratulations.
All right.
And the last winner is Shadeja Freeman. They'll be like, oh,
hey.
Like how do people keep winning?
They keep winning because they are going in and entering the keyword.
They're entering the keywords. If you are just picking any keyword, your name is
not in the drawing.
So do not just
there.
say, I think the keyword is going to be YMA.
Yeah.
Yeah. The staff is just going to toss it away. Yeah. So make sure you watch the podcast and your name.
We'll drop it somewhere in there.
Yeah, it's going to be in there, guaranteed.
Yep.
You ready to get started?
I am ready.
All right, let's see what we have today for Real Estate Wednesday.
I said I was getting my board, so I got my board.
Okay.
Because real estate's a lot of math.
Okay.
Right?
Yes.
So today we're talking about, because in previous episodes, if y'all have watched, we talk a lot about debt to income.
Okay.
So I'm going to break down what is debt to income today and how do you analyze that to understand where you are financially to be able, are you ready to buy a house or not?
Got it.
Right?
So today's subject is debt to income?
Debt to income.
The whole show is going to, that's a lot.
It's really not, because debt to income is very intricate.
Okay.
And so a lot of people really don't understand. So I'm going to break it down a couple of ways so that people can really see and understand what they need in order to qualify to buy a house.
Guys, you heard what she said. It is a very intricate mathematical functionality system and thing to learn. Okay, she didn't say all that, but pay attention. Let's go.
Y'all just pray for me. No, so seriously, debt to income is expressed by a percentage and is your total minimum monthly debt divided by your gross monthly income.
You have to break that down for people.
that's why I said it's very intricate.
Okay.
Like, how many people understood what I just said? What?
Besides me.
Besides you.
I'm
So,
sure a lot of people did, but the people that don't know.
right. So your debt to income should be at or below 36%. So we're going to show you the basic example of what this looks like.
Okay.
So y'all bear with me. Are you going to be my board holder?
I will.
Oh, look at him go, you guys.
So you're just going to write right here?
Yeah. So this is an example. If your mortgage is $1,100 per month, and your automobile payment, which this is a little on the low end for what we see, but $300 a month.
Okay.
And your credit card payments are $200 a month, which is lower than
most people have a lot more than that.
And that would mean that your total monthly debt is $1,600 per month. If your monthly gross income is $4,200 a month, which is a little on the high side for the average pay in the upstate South Carolina, but just on average, $4,200 a month. That will put your debt to income at 38%. So you're right over that 36%.
So explain to the people, how did you get 38%?
So I took your $1,600.
Okay.
And I divided it by 4,200.
Okay.
And that gives you 0.38, which if you multiply 100, gives you 38%. So now, this isn't realistic for what we see people have on their credit files, right? So typically, if someone's coming through the pyramid group and we're doing this analyzation, typically they don't have a mortgage yet. We're just doing their debts and doing their what-if mortgage based on what their income is.
Okay.
So the reason that this is important is because when a lender is going to lend you money, they're going to use this type of analysis to say, well, based on your monthly gross income and based on your debts, this is where your debt to income is. So it's either going to qualify you for a house or you're not going to qualify based on your debt to income ratio. I can tell you that we typically see, even if you have a credit score of over a 640, if you don't have the income to sustain the amount of debts that you're carrying on your credit, then you're not going to qualify for a house.
So why do a lender, because I'm sure if I was sitting out, if I was on my cell phone or at home,
right?
I'm seeing this right now, I'm thinking, why is this important to a lender?
Well, you have to think of it like this. A lender is getting ready to loan you anywhere from, $100,000, $150,000, $200,000, $250,000 to go buy a home. They want to make sure that you can afford what they're getting ready to lend you. So if someone can't manage their debt as it is, then they're a higher risk for a lender to then go in and give them more money.
I think that's important because if I gave someone money and I use this same analysis and this person, if their debt to credit was like 80%, that means that when they pay all their bills, their debt to income was 80%. That means that they probably maxed out. So if there's anything that happens, any type of emergency that comes up, automotive, mechanical issue comes up,
right? Then
what happens? They're going to prioritize what's more important right now. Is my car more important that's helping me get to work, or this mortgage?
Or this mortgage.
Well, I could just move out back to my parents' house or whatever the case is. So they want to make sure that there's enough remaining money that after all your bills are paid, there's still money left over.
Right. So I'm going to also do an example of what we typically see and why debt to income is such an issue with people and they're getting their pre-approvals.
Okay.
Because a lot of times when we transition people, and this is, of course, in the upstate of South Carolina through our company, the Pyramid Group, when we're transitioning people over, we typically want them to be at 640 or above. That's where we want them to be credit score wise to qualify for different programs.
Hold on.
I started off checking it every other week, just like most people do. Then it got out of control. I couldn't help myself. I started checking it day after day after day. I didn't realize that I was becoming addicted until my wife said something.
What did she say?
She said, "It's just a credit score, relax."
Are you checking your credit score?
Huh? Hold on.
What she means by that, when she says that keyword transition, that means that someone started, they had a goal and they wanted to become a homeowner, but their
Right.
credit scores were not where they needed to be. So they went through a program through Masters Credit Consultants.
Right. He's throwing the plug in. Yeah.
I'm throwing a plug in. Masters Credit Consultants. They went through that
Right.
program and they got their scores up to qualify. So when they transition, the Pyramid Group, that team said, hey, their scores are strong enough now to bring them over to us. Now let's start preparing them.
And we can do that for anyone across the United States.
Yes.
And when they're ready to transition, what we do is we find them a great referral agent in their area
Right.
to assist.
Right. We do that now.
Right.
Well, your team does that now.
Right. The Pyramid Group does that now. But we're able to help anyone who has that goal, who is having some credit issues, go from Masters Credit Consultants to the Pyramid Group. And the good thing is I'm the lead generator for the Pyramid Group, but I also understand how to do a credit analysis to the point of doing your debt to income mathematics for you, so you're not at home trying to figure out what your debt to income is. So I'll go through your credit file and say, well, based on your credit file, if we were to go to a lender right now, this is what I think, because I'm not a lender, you would qualify for. Roundabout numbers. Typically, I'm pretty spot on just because I understand, just based off what the lender's qualifications are,
Right.
what someone's going to be able to be approved for. Now, we do that because anytime a lender pulls your credit, that's a hard inquiry on your credit file.
What's a hard inquiry?
So a hard inquiry is one that's going to impact your credit scores. So
Okay.
you have people who don't seek the professional assistance of a real estate agent or someone who is well versed in credit and real estate.
I like
as
how
we
you put
are.
that. I like how you put that. You was very safe with that. Good job.
And we're able to try to help you before you get the inquiry. So we have people who will go out and they'll be like, well, I went to a mortgage lender and they pulled my credit scores and they're only a 580. Well, we knew that. That's
Right.
why we didn't tell you to go to one yet.
Right.
Right?
Or they were just driving through, hey, there's a new subdivision, and
I
we
went-
went
I
over
went-
there, and they
And they said we don't qualify.
they pulled
And
our
sometimes
credit.
it's not the credit. Sometimes they'll be like, well, my credit's okay, but my debt to income. And then they'll come for credit assistance because of their debt to income. Now, that's kind of a tricky situation because sometimes the credit is the issue on the debt to income. Sometimes it's just the amount of debt that that person is carrying in general.
Okay.
So what I mean by that is you have positive debt and you have negative debt. Your positive debt is your car payment, your student loans. That's positive debt. You say positive debt, right?
Right.
That means it's something that you're paying on month over month. It's in a positive status on your credit file, but it's still going against your debt to income ratio.
So it's positive debt.
Right. Then you have your negative debt. These are things that may be in collections or accounts that you've allowed to charge off that are still with the original creditor. And typically they take 5% of that debt and count it against your debt to income ratio. So let's say you have a total negative debt of $10,000. They're going to take 5% of that and count it against your debt to income ratio.
So you're saying if I have $10,000 of bad debt,
Mm-hmm.
and 5% of that is $500,
Right.
you're saying that they're going to take that same scenario that you had earlier when I bring in a gross of $4,000. How much was it?
4,200.
4,200, and they're going to deduct that 500 from it.
Right.
Okay, and that would impact how much of a home I will qualify for too, right?
Right. Right. Because if you're adding on $500 worth of debt that you typically don't have, then that's $500 worth of home that you can no longer afford.
Right.
So we're going to actually break that down
Okay.
so that people can get a visual. I'm a visual person, so I like having visual because especially when you're doing math and trying to explain to someone what something is, I love visual effects.
Do I get to hold it again, or are you going to just
I'm
write
going
it
to
down?
write it and then I'll go through everything,
Okay.
you know, as I'm writing. So
I got to feel like I'm important on her show today.
do you want to hold it?
No, go ahead
I
and
think
write
he
it
wants
down.
to hold it,
No,
guys.
go ahead, because it's probably
Okay.
more harder for you to
right.
write up in the air.
So if we take a typical income, and I'm going to do for this area,
Okay.
what we see, which is typically around like $3,500 a month income. Here's your income. And then I'm going to take your positive debt, and I'm going to take what we typically see on one of our credit files.
I'm surprised you didn't put student loans on there earlier.
I'm doing, this was my student loan one.
Oh, okay.
So, so the positive debt, typically we see car payments. Most everyone has a car payment. So, credit expert over here, what is the typical car payment that you see on average?
Around $450.
$450. Look, we was like right there with each other. I was gonna say 400. Okay, and then student loan debt.
She just want to be close to my numbers. That's all.
Student loan debt. What would you say is the average amount of student loan debt that you see on credit files?
Ooh, on average, I would say around 75,000.
I would say that is about right. So 75,000 in student loan debt.
You gonna give it up for Joe again?
So the way that you would take that 75,000 and make that a per month is you would take 1% of that, because on an
$750.
FHA loan, FHA is going to be a 1%. So that's how much
$750
per month.
per month.
Yep. All right. So
Question
that's
before you keep going.
okay.
What happens, because I'm thinking on the opposite side, what happens if my student loans are in deferment?
If they're in deferment, the only way that you can count that I know of from lenders that I've talked to,
Okay.
the only way that you can count the $0 a month payment is to do a conventional loan. Conventional loans can be anywhere from 3 to 10% down, depending on your credit score. Typically, on a conventional loan, your credit score has to be higher,
Okay.
more like 660, 680 credit score for conventional, and just different stipulations.
A larger down payment, a higher credit score.
Yeah.
So if
And sometimes the rates are a little bit higher on conventional.
got it. So what that means is if you're trying to qualify for a higher priced home, but they're counting that $750 against you, so you don't qualify for it, then there's alternatives by having good credit, putting
Right.
more down, and accepting that higher rate of interest.
Right. It's not too much higher, but it is going to be a little bit.
So there's ways.
But there's ways
okay.
to negate that.
Okay.
And on a USDA loan, they're going to count 0.5%. So that cuts it in half. But a lot of what people don't understand is you get 100% financing USDA. They're only counting 0.5%, but they're only allowing a 41% debt to income.
Okay.
Where on an FHA, they're counting 1%, but they're allowing about a 50 to 51% debt to income.
Wow. Okay.
So you're gaining anywhere from 9 to 10% in going FHA and bringing 3.5% down.
Right.
So you're able to buy more house. Typically, that 0.5% on a USDA is negated by the debt to income ratio.
Got it.
Because typically we see that people have just more debt anyway.
Are you trying to start or grow your business? Well, welcome to YMA Financial, where we have created the ultimate platform for entrepreneurs and business owners. We specialize in small business startups. Our accredited business consultants will help turn your dream to a reality. We'll help obtain your business documentation, help you establish and build business credit, and whether you're working from home or storefront, we'll help fully launch your business. Check out our website at www.ymafinancial.com or give us a call at 888-531-6611. Good information, right, guys?
Yeah.
Good information.
And then we also, personal loans are also positive debt, as long as they're being paid on time. So on average, what would you say that people pay in personal loans per month?
The average person probably have a personal loan of like around somewhere between $5,000 and $10,000.
So that would put a monthly payment per month?
Yeah, they may be paying around $150 to $200 a month.
So we'll do $175. How about that?
Okay.
Per month. All right. Now, negative debt. How much do you say on average that people have in negative debt?
Wow, that is a broad question. I would say an average, if I looked over the last 5 files that we did a consultation on, the average negative debt, considering like collections, would probably be around $30,000.
So what's 5% of that? Mathematical genius.
1,500.
1,500.
Yes.
So this person right here, you ready? All right. This person right here has an income of $3,500. We're going to do an addition of all of the debts that they have. So we're going to say that, and I'm using my calculator down here. So 450 plus 750 for the student loans, plus 175 plus 1,500 in negative debt. That's $2,875 in debt. $2,875 in debt. They only make $3,500 a month.
Wow. We may need to adjust because like the people that.
No, I'm gonna do an adjustment. I'm just saying, typically on average, this is what we see. So this is why people need help with their credit file. This is why people need to understand that not all positive debt is good debt.
Right.
Because it impacts your debt to income ratio.
And this, I gave that number over the last couple of people that joined our program. They had like cars on their credit, like a repo on their credit. So, that could be like $18,000 right there just on a car that has been repoed.
So even if you take out the negative debt, so we can do it like the negative debt doesn't exist. That would bring your total to $1,375.
So imagine if you went through like a credit program and if you didn't have those items on your credit. Now this is where you're at. So now go ahead and calculate it.
Right. So $1,375 divided by 32. I said 3,500 down. That puts you at a 39% debt to income ratio.
So I will qualify.
Possibly.
Okay.
So what you have to look at is what program are you qualifying for? So FHA will go up to like 55%. So it's really the difference in, your debt and your income.
Okay. So if I was that person on the opposite end right now, I'm out there in the world and I am seeing YMA Nation podcast and I want to answer, like I'm thinking, okay, how can this work for me? Because I just watched how she broke down the numbers. I know my car payment is X amount and my student loan amount is X amount. And I got a doctor's bill that's around like $5,000 in doctor bills. Now, after I do the
So-
same equation that she just done,
This is what I do. So on an FHA loan, you say $3,500 is what you make.
okay, $3,500
You multiply
of
that by 51%.
Okay,
So 3,500 times 51%, that leaves 1,785.
okay,
So you take the 1,785, and now I'm going to subtract what my debts are per month.
okay,
So you say minus 450 for my car. That gives me 1,335 minus 750 for my student loans. That leaves me with 585 minus 125 for my personal loan. That leaves me $460 to buy a house with
So when
on an FHA loan.
you say $460 to buy a house with, you say
That means you're probably not going to qualify. That's your house, your mortgage, your taxes, and your insurance.
okay. Well, again, I'm on the opposite side.
So,
And I'm just
yeah,
trying to find
right.
an answer, a solution.
So the solution is, look, Mr. Problem Solution.
Problem solutions. Like, we want solutions.
So you need the student loans, you need to go away.
Okay.
The way that you do that is you can do either an amortized payment plan. That means you're not on an income-based payment plan, or you can go conventional, which means your credit score needs to be up higher. But typically what we see is they're right at that 640 mark, and some people just don't have that time. So if you don't have the time, then you can get on an amortized student loan payment where you're paying a lower payment than this a month. So let's say you call the student loan company and you say, I want to get on a student loan payment, and it's like $200 a month. Now you freed up $550.
Got it.
The
Same
other
thing
thing
if
that
I
you can
paid off that
do if
personal
you pay
loan.
off the personal loan, that's freeing up $125.
Right.
And then also car, you may look at refinancing your car.
Lower car
So let's
payment.
say that your car, when you obtained the car loan, your interest rate was at, 16%. And you can either trade that car in because now your credit's better and you can get a different car, lower interest rate, and then be able to lower that car payment down.
So if someone out there had questions, they would call the Pyramid Group.
Yes, that is 864-249-1437.
1437.
Yeah.
864.
We have a lot of numbers here.
1437. Yeah. 864. There's always 864-249, and there's whatever division that
Right.
you're going to. And their keyword.
And the keyword is debt.
The keyword is debt. DEBT.
Yes.
The keyword is debt, guys. So there it is. Man, they had to watch the whole show to get to the keyword. You didn't have to watch the whole show for mine. I gave mine like somewhere in the middle. But guys,
We were giving out numbers. We want people to understand how important it is when you go take out new loans and you're trying to buy a house, or you go buy a new car, but you want to go buy a house.
right, the impact it has.
The impact it has on you. And then, they come to us and they're like, well, I need to buy a house because my lease is up in a month or my lease is up in 3 months. Well, you just, added, even if it's positive debt, you just added that to your debt to income.
Right. And now that $180,000 house they want, now they only qualify for $140,000.
Right.
Guys, knowledge is power, guys. Thank you so much. The key word she just gave you guys, debt. Make sure down in the description, you
Click the link.
You click the link.
Yeah.
You click the link. It'll take you to the website. You put in your information and you type in debt. There
Had
it is.
fun, guys.
Man, Real Estate Wednesday. Good job. Real
Yeah.
Estate Wednesday. I love this background. Like, as we talk, it just like, it jumps out at me.
I like my little board.
You like your board? I'm gonna have to get me a board now for wealth building.
Why are
Monday.
you trying to copy my board, y'all?
I have the outdoor. All this coming down.
Right.
We go put a TV screen. We go put a screen right here, right? Yeah, that's what we're gonna do. Guys, thank you so much.
Thank you, guys.
Yeah, for watching Real Estate Wednesday today. We'll see you guys for Friday football.
Oh, that's going to be fun.
Friday football, guys. Thank you. Make sure you like, comment, and subscribe. We'll see you then.
See you then.
View what the bosses view. You gotta sacrifice. You wanna move like bosses move.
YMA. Young Millionaires Association. Yeah, see, that's the association. Joe.